What if the next stock market crash doesn't begin on Wall Street, but inside a data center? Most people think crashes are triggered by sudden events, wars, inflation spikes, political instability. But markets usually weaken long before panic becomes visible. The earliest warning signs often come from technology, the backbone of today's global economy. Nearly every industry now depends on tech. Banking runs on servers. Retail runs on cloud systems, manufacturing runs on automation. When tech spending slows, it usually means companies are preparing for tougher conditions ahead. Let's start with semiconductors. Chips power everything: smartphones, cars, AI systems, and data centers. When chip demand rises, it signals expansion. When it slows, it suggests caution. Before the 2000 dot-com crash, semiconductor orders began declining months in advance. Watching companies like Nvidia and Taiwan Semiconductor Manufacturing Company can offer clues about global demand expectations. Their earnings often reflect future confidence, not just present performance. When chipmakers guide lower for future quarters, it's rarely random. It often reflects weakening orders across multiple industries at once. Another key indicator is cloud spending. When businesses expect growth, they expand aggressively on cloud platforms. But when uncertainty rises, executives start cutting or optimizing spending. Growth slowdowns at Amazon Web Services, Microsoft Azure, and Google Cloud have historically appeared before broader market weakness. Executives rarely say, "We expect a downturn." Instead, they say customers are being more efficient. That careful wording often signals defensive budgeting behind the scenes. Venture capital trends also reveal risk appetite. During optimistic periods, funding explodes. But when confidence fades, startup investment drops quickly. Before major corrections, private funding often slowed before public markets reacted. Innovation pipelines shrink, hiring slows, and eventually earnings feel the pressure. A funding slowdown may seem isolated at first, but it reduces future growth across the entire tech ecosystem. IPO activity tells a similar story. In bullish times, tech companies rush to go public at aggressive valuations. But when volatility increases, IPO pipelines freeze. A silent IPO market is often a powerful warning sign that institutional investors are reducing risk exposure and protecting capital. Consumer behavior adds another layer. When people delay upgrading smartphones or laptops, it reflects tightening budgets. Companies like Apple Inc. may still generate revenue, but slower upgrade cycles indicate caution spreading through households. Small shifts in consumer demand can ripple through supply chains and eventually pressure corporate earnings. Hiring trends inside tech companies act as early alarms as well. Before layoffs become headlines, hiring freezes begin. Job postings decline. Recruiters slow down. Monitoring employment shifts at firms like Meta Platforms and Microsoft can reveal stress before earnings reports show it. Companies don't pause hiring unless they see potential slowdown ahead, then there's margin debt. When investors borrow heavily to buy volatile tech stocks, the system becomes fragile. If prices start falling, forced selling accelerates declines. Excess leverage has amplified nearly every major crash in modern market history. What begins as a correction can quickly turn into panic when borrowed money must be repaid. Even internet search behavior reveals psychology shifts. When searches move from best stocks to buy to market crash or recession, it reflects rising fear. Platforms like Google Trends allow analysts to observe collective sentiment in real time. Fear spreads digitally long before it shows up in official economic reports. Here's the critical lesson: crashes rarely arrive without warning. The signals appear quietly first. Semiconductor demand softens, cloud growth slows, venture funding declines. IPO markets freeze. Hiring pauses, inventory builds, leverage stretches too far. One signal alone means little. But when multiple indicators flash caution at the same time, risk levels increase dramatically. The market whispers before it screams. And in today's digital world, those whispers often come from technology first. If you learn to watch infrastructure instead of headlines, you won't just react to the next crash, you'll anticipate it. You'll protect your capital when others are overconfident, and you'll recognize opportunity when others are afraid. Because preparation isn't fear, it's strategy.